Welcome to the Deep Dive, where we take the fire hose of earnings data, distill it down, and deliver the clear, actionable signal straight to you. Today, we are dissecting a really brutal market reaction. We're talking about Paysafe Limited, ticker PSFE, after they released their third quarter 2025 results.
And that release was, it was just catastrophic for shareholders. The market delivered this massive, immediate drawdown. And our mission today is to pull apart those numbers because there's this weird story here of strong organic growth and a complete operational failure at the same time. We need to figure out why the market reacted with, such deep skepticism.
Okay, so let's start with the headline shock, because you're right, the press release told two completely different stories. On the top line, revenue was $433.8 million.
Which was a slight miss. Consensus was a little higher, around 440.
Right, and reported growth was only 2% year over year, but the organic growth, the ongoing business, was a much healthier 6%.
Yeah, that top line number wasn't the thing that crashed the stock. It was a little disappointing, sure, but not the driver. The trouble really started with profitability. Adjusted EPS, so the non-GAAP number, came in at 70 cents.
Which missed the street's 72, 73 cent expectation.
It did.
Yeah.
But we should say that 70 cents was still up 37% from last year. So on its own, not terrible.
But then you get to the number that caused the immediate sticker shock, the one that probably had analysts hitting the sell button before the call even started. The GAAP net loss, it widened massively. We're talking $87.7 million.
Right.
Compared to only a $13 million loss last year, an $87 million loss just looks disastrous.
It does. And we have to clarify this immediately because that gaping gap loss is functionally a phantom. It's not real. It's almost entirely driven by an $81.2 million non-cash tax charge.
A tax valuation allowance, right?
Exactly. Management said it was tied to new U.S. tax legislation, which they call the One Big Beautiful Bill Act, which is memorable.
So if I'm hearing you right, this is a paper loss. It's an accounting thing, not cash leaving the bank.
Precisely. It's non-cash. And this is the critical footnote. It does not impact their current or future cash tax payments. But psychologically, you see an $87 million loss flash on the screen, and it just shatters the whole picture.
Okay, so let's set aside that non-cash hit and look at the actual operations. Because in there, the company seemed to have pretty strong momentum.
It did. And this is where the story gets so complicated. They're executing well in certain areas. Merchant Solutions grew 7% organically, even with a headwind from a business they sold off.
And digital wallets, the high margin part they're trying to grow?
That was up 4% organically. And geographically, both North America and Europe grew around 8% if you normalize for currency.
And of course, the big growth story everyone watches, iGaming.
Oh, absolutely. That continues to be just phenomenal. It was up around 50% this quarter. So you add all that up, and the adjusted EBITDA itself grew a respectable 7% to about $126 million. That's a 29% margin for the quarter.
So, okay, here's the multi-million-dollar question then. If organic growth is strong, iGaming is up 50%, and the Q3 margin was 29%. Why did the stock crash almost 30%?
Because it's an issue of quality, not quantity. And that's the core conflict. It all comes down to this unfavorable business mix shift. They are succeeding, but they are succeeding too well in the wrong places.
Okay, define the wrong place for us. What does that mean?
The problem is that all their outperformance is happening in their lower margin ISO merchant channels.
ISO meaning independent sales organization.
Exactly. Think of them as third-party resellers. Paysafe uses them to sign up small businesses, but they have to share the revenue. So the EBITDA margins in those channels are tiny. Like single digits, 5 to 9% maybe.
And that's growing faster than their premium channels.
Way faster. Their direct to SMB and e-commerce channels, where they keep all the revenue and have margins in the mid-20s, are growing much slower. So the low profit business is outpacing the high profit business, and it's just dragging the whole average down.
So the market is punishing them for the wrong kind of success.
That's it. And management had to admit on the call they were, quote, too optimistic about shifting this dynamic in 2025.
So what did that mean for Q4? What was the damage they projected?
Well, because of this mix shift, they had to warn everyone that Q4 adjusted EBITDA margins would fall sharply, down to roughly 23%.
Wow, from the 29 they just posted. That's a cliff.
It is. And that drop forced them to revise their full year margin down to about 25%. And that told the market this isn't a temporary blip, it's a structural problem.
Which brings us to the balance sheet, because with this company, leverage is the anchor on the whole investment case.
Anchor is the perfect word. Total debt is still stubbornly high at around $2.5 billion. That leaves their net leverage at a really restrictive 5.2 times.
And for context, 5.2 times debt to EBITDA. That's high. Most payment companies want to be under 3.
Oh, it's very high. It means every single dollar of cash flow is under a microscope. They have no room for error, they're completely constrained in their ability to invest, and any hint of a recession just raises solvency concerns.
And the quality of their cash flow, the free cash flow conversion, that also got worse, right?
It did. Unlevered free cash flow was about $83 million. It sounds okay, but the conversion of EBITDA dropped to 66%. It was 76% a year ago. When leverage is this high, you need every penny of that EBITDA to turn into actual cash to pay down debt. And right now, it's not.
So that leads us right to their strategic plans and the reality check management gave on the call.
Yeah, green flags were pretty much just in iGaming. They're doing well there. They pointed to new deals with BetMGM in Ontario and Underdog in the U.S. They are successfully embedding themselves in that growth story. That part is working.
But the big headwinds are in the digital wallet segment, the exact segment that is supposed to fix this whole margin problem.
Precisely. They admitted that the classic wallet line and new products, like their business wallet, are all moving slower than they planned. And when analysts pushed them on it, they were pretty blunt. They said navigating the regulatory and bank approvals was like moving a boulder uphill.
I appreciate the honesty, but moving a boulder uphill doesn't exactly scream confidence that a turnaround is coming soon.
No, it signals a total lack of visibility on the timeline, which is just poison for a stock with 5.2 times leverage. And then on top of that, they mentioned in the Q&A that a client in a higher-risk e-commerce vertical shut down late in the quarter.
Leading to a write-down.
A write-down of several $1 million. Just highlights the volatility they still have in some of these legacy businesses.
So this triple whammy, the margin pressure, the slow wallet execution, and this surprise client risk, it all led to the guidance reset that just blew up the stock. Let's run through those cuts.
Okay, so revenue was cut to $1.7 to $1.71 billion. That was sort of at the low end of the old range. Manageable.
Yeah.
But the big one was profitability. Adjusted EBITDA was cut sharply down to $425 to $430 million.
That is not a small tweak. The high end of their old range was $478 million.
Yeah.
They're slicing almost 10% off their profit projection.
It's a massive cut, and it just signals a severe lack of control over their own business. And as a result, adjusted EPS got cut dramatically too, down to a range of $1.83 to $1.88.
And they basically confirmed the whole repair timeline is pushed out now.
Yeah. They said 2026 would see mid to high single-digit organic growth, which is fine. But they explicitly said the critical target getting leverage down to a manageable 3.5 times is now delayed until 2027.
So that slow timeline and the huge miss, that's what catalyzed the market panic. How bad was the drop?
I mean, it was just jaw-dropping. The stock fell about 27, 28% in the hours after the call. It kept falling the next day for a total 2-day drop of around 34%.
And the volume.
Astronomical, about 5.5 times the normal average. That big institution's just getting out, de-risking completely.
So what were the analysts saying to justify that kind of exit?
It all came down to the leverage and the execution risk. The story is now totally dominated by the 5.2 times debt. And you saw it in the price targets. RBC cut their target from $17 down to $10. UBS, which already had a sell rating, slashed their target from 12 all the way down to 7.
So the message from the street is, we like the iGaming growth, but we hate the margin quality, and we don't believe you can pay down the debt fast enough.
That's it in a nutshell.
Which creates this huge disconnect where the stock price has been absolutely decimated, but parts of the underlying business are actually growing really well.
And that brings us to our next segment.
Right. This is not financial advice, where we explore an outrageous but plausible trade idea based on our deep dive.
Okay, so the whole premise here is based on what management is doing with its own money. The stock is now trading way, way below $13.62, which is the average price where the company bought back 1.5 million shares in Q3.
So the board thought the stock was a good buy at almost double the current price.
Exactly. And now, with the stock near $7, the board just authorized another $70 million for buybacks. That leaves them with $97 million left in the program.
So they have nearly $100 million in dry powder, and they clearly think the stock is cheap. The question is, will they actually use it?
That's the bet.
Yep.
The trade idea is a highly leveraged bet on this management-imposed floor. We're thinking about an option strategy, something like a long-dated, deep-in-the-money call option paired with a short put spread.
Okay, so basically a synthetic long stock position, but with some defined risk.
Right, you're making a leveraged bet that management is about to step in and buy stock with urgency. If they start buying back $97 million worth of stock at $7 a share, that provides a huge short-term floor. It could stop the panic selling.
And the second part of the bet is the potential reward if they ever turn things around.
The second part is that leveraged exposure to the recovery. I mean, they're still projecting growth, and that 2027 target of 3.5 times leverage is still their North Star. This trade is a bet that the buyback saves you in the short term, and the long-term deleveraging story gives you that re-rating upside. It's a high-risk bet on management finally getting it right.
It's fascinating. So let's recap the core finding here. Paysafe is generating real organic growth, especially in a hot niche like iGaming, but the market is just ruthlessly prioritizing margin quality and the balance sheet over that top-line number.
Yeah, the market is penalizing the fact that all their success is coming from the lowest margin channels, while the high-margin wallet business, the future of the company, is, as they said, moving like a boulder uphill.
Which leaves us with a final provocative thought for you to mull over. Given management's acknowledged slow progress on fixing this margin mix, is that $97 million buyback authorization a smart use of capital to support a beaten-down stock? Or is it just a costly distraction from the real problem, the need to accelerate the execution on their profitable products, which is the only thing that can truly fix that 5.2 times leverage problem?
And that decision buybacks versus execution is what's going to determine if Paysafe sinks or swims over the next year and a half.
Thank you for joining us for this deep dive. We'll catch you next time.